But the one thing that a lot of people don't really take into consideration when they go to invest overseas is how the currency changes or exchange rate plays into returns. So for instance, we call this normally taking a hedged and unhedged exposure. Hedged being you can sort of lock in your currency risk. Unhedged, you play with exchange rates. And more recently, if you've seen the Australian dollar drop, or your international losses haven't gone down by as much. But now we're seeing if the Australian dollar rises, well, you're not getting as many returns from your international exposure. I mean, at Magellan, you've got sort of two plays. I know the more broader strategy doesn't really have an exchange rate play or a currency play, whereas the fund you manage, it takes a currency approach as well. Is that right?
It does, yeah. Maybe I wouldn't characterize it as playing with currency.
Playing with currency, probably not the right exchange rate.
Yeah, well, yeah. We're so I'll take a step back and explain the different product offerings at Magellan and whether they do or do not have currency hedging within them. So our global fund that you mentioned, which is the sort of broader product that you referenced, the sort of 25 stock portfolio, we offer that as a completely hedged or a completely unhedged unit class. Mm-hmm. So clients, advisors, they can sort of pick the degree of hedging. They could do 100, 0, 50, 50, whatever split they want between either the fully hedged or the unhedged.
Yep.
But then you're right, within our high conviction strategy, we've got the high conviction fund and the high conviction trust. Both of those products have an active currency hedging program built into them. And we're not actually trying to drive any additional value from any of the currency decisions we're making. It's actually just trying to take some of the downside risk out of those portfolios for Australian investors investing in these international businesses. Yep. And all we try and do is just sort of recognize where the currency is today relative to our, conservative and rough estimate of where the fair value is for, let's say, the Aussie US. And if we're at a meaningful discount to what we think the fair value is, we'll look to be pretty hedged at that level.
Yep.
And as the currency is rising from that level where it is today back towards fair value, to your point, Stefan, there are going to be headwinds to investors' Aussie dollar returns from their equity portfolio. We want to offset that currency headwind with the gains that they'll receive from that hedge. On the other hand, should the Aussie run through our estimate of fair value and increase to a very high level, we want to layer off the hedging and just sort of allow the hedging to roll off to a lower level. And, such that if the currency moves from that high level back towards fair value, investors are benefiting from that currency gain.
Yeah, that macroeconomic play I feel is so important when investing overseas, because you get it wrong and you can really erode your returns or magnify even your losses. Getting that right within the strategy, I think it's a big thing, and people need to consider it more. If they are going to invest overseas, well, what's going to happen in the macroeconomic environment? I was talking to my father not long ago. He bought some shares in the US. I think he bought them back in 2009. And the Australian dollar was basically par for par with the US.
Yeah, great investment.
Yeah. So the investment has dropped in value, but his return has gone up.
Okay.
So he's like, oh, well, things aren't too bad.